June 1st means it is the first official day of hurricane season. The National Oceanic and Atmospheric Administration, NOAA, predicts there will be fewer storms than normal this year. It forecasts calls for 0 to 2 major hurricanes. Bloomberg's David Gura has the details.
All right, so NOAA is saying here the reason for that prediction is that there are going to be warm temperatures in the Pacific. This is known as El Nino. Of course, when they forecast for below normal season, that can often be inaccurate. A forecast is just a forecast, and perhaps the most salient example of that comes from 1992. That was supposed to be a below normal year. That was when Hurricane Andrew, a Category 5 storm, hit the U.S. and caused a tremendous amount of damage, more than $25 billion worth of insured losses. That was the fourth costliest disaster in the last 40-plus years. Now, more and more investors are paying attention to hurricane season. They've been pouring money into what are called catastrophe bonds or cat bonds. And these are high-yield instruments, alternatives to traditional reinsurance. And the way they work is if there are no major hurricanes, the investor is going to get a pretty good return, especially in this low-yield environment. But if there are catastrophic storms, he could lose tons of money. And investors like these because of the returns that they can get and because they're not correlated to the stock market. They're correlated to weather. Now, since the financial crisis, the bond market has seen double-digit annual growth in these. $22.1 billion worth of cat bonds were outstanding at the end of March. And so these are being issued by reinsurers and insurers. They're increasingly popular with hedge funds and with pension funds. Now, not everyone thinks that their surging popularity is a good thing. And what's attracting a lot of attention is this new book out by 3 business school professors. They're arguing that these are, in fact, very risky. And as that risk is being spread around, maybe investors don't fully appreciate how risky, in fact, they are. So, Steph and Eric, just to recap the way these work, if I'm a small business owner, say, on the Carolina coast, I take out insurance because of a hurricane. The insurer goes to the reinsurer to allay some of that risk further. Now that is being parceled out, farmed out even further to investors. That's the way that these cat bonds are working.
Yikes, that doesn't sound like 2006, 2007. Thank you, David Gura.